we go. What is up, everybody? I'm Chase Sloan with the Chasing Real Estate Group, and I am here with our local lender partner, Cliff Saunders with Guaranteed Rate Mortgage. Everybody say hello.
Hello.
I called Cliff all the way in from the beach. You know, he's taken this time out to really kind of partner up, and we wanted to be able to just have a transparent conversation about what's going on in the real estate industry and also what that means for you guys as buyers, and maybe kind of dispelling some of those myths around buying a house. You know, I know it's easy for people like you and me that do this every day, and yet I want us to really step into the shoes of
Yep.
people that have never bought a home, or
Yep.
maybe it's been.
You want to walk in their footsteps, basically. Yeah.
Exactly. It's been a couple years and there have been like some changes. And so just, you know, let's just jump right into it. Not a whole lot of introductions. Cliffs, what are you seeing happening right now?
Well, first of all, I say, you said it's been a couple years. Remember, mortgages change, it seems like every 3 months.
Right.
Every time the season changes, there's something new. And that's why, whether it's me or another lender, you want to work with a professional that knows what they're doing, you know, and understands, because there's always so many changes. You know, I always say the one thing in life that stays the same is change. So always be that. But when you're working with knowledgeable people and me, we're going to keep you up to date. We're going to make sure we get you all the right information. So yeah.
Talk about that when you're talking about a lender, because I have clients and they'll, you know, sometimes come with online lenders or maybe somebody that they just picked up. I mean, what should buyers be looking for in a lender?
Okay, well, that's a good question. You know, you want a good, reputable lender, of course. You know, I always like to think I'm the best, but I know I'm not. I know a couple loan officers that are a little bit better than me in other states, but I'm not going to tell you who they are. But I know I'm pretty awesome. You know, but I would say where it comes into is you want to work with a lender that has been in a business for a while, you know, not just somebody that's brand new. Secondly, sometimes I've seen lenders that have been in the business for a while, but they don't do a lot of buyers. They don't do a lot of deals, so they might not have as much experience. As long as they're well educated, you know, I always say Google them, see what's out there, see what reviews they've got, you know, and if they're local, that's even better, because they're going to know the local market, they're going to know the local guidelines, they're going to know the local rules, they're going to know the local realtors and the listing agents and things like that, which is going to make it easier for you to get your house under contract. Not to say that, you know, online lenders are bad or anything. There are good ones out there. You know, there's good people in every bank, and it's not necessarily the bank. It really just comes down to the person. Are they going to be looking out for your best interests? You know, do they have good integrity? Do they have good reviews? You know, do they care? And understand, and then some people, that do they work with the low income borrowers as well as the high income borrowers, you know? So I've always prided myself that I don't care if it's a $50,000 house or $1 million house, you know, you're going to treat your customers the same and treat them fairly. So when you're looking for a lender, you just want to make sure that they're very clear on, you know, explaining the entire process. Cause I do see a lot, especially when dealing with first time buyers. I get it all the time. I think I had like 3 calls this week. So they talked to other lenders, and they had a 5-10 minute conversation with me, and they say they learned more in 10 minutes than they've been with 3 weeks with the other person. Yeah. You know, because I sometimes don't think as myself as a lender. I think myself as an educator, because my job is to educate them on the process and what's going on. And then my job is also as a guide, where my job is to guide them down the right path, because a lot of times customers nowadays, they are educated, they read everything online, but they don't have an understanding or a grasp of it. So you want someone who understands and who's a good guide that says, based on your criteria, this is the best way to go, not this way. Even though you can go both ways, hey, my job is to make sure they understand all the directions they can go. I'll give them my recommendation, but then they're the boss. They're going to ultimately pick it in the end. But if we don't educate them, then guess what? That's where you're at. So you just want a good educator. And I think that right there goes a long way. Someone to hold their hand, you know, even second-time buyers, especially with the guidelines changing all the time. I'll get some second-time buyers. They're like, well, the first time I bought a house, and I was like, when was that? Oh, back in 2005. I'm like, yeah, you just had to have a pulse back then to buy. It's way different now, you know, so.
Absolutely different. And, you know, and you touch on such a great point, because you say, like, there's so much information out there. I mean, you can Google yourself into confusion, especially when it comes to the home buying process. A question that we often get, especially from buyers either that are new or haven't been in the market in a while, is how much money do I need to buy a house? I mean, how do you answer that question?
Well, that question gets complicated sometimes. There's so many different routes, but I always ask them a few simple questions. First I ask them, hey, are they a veteran, right? That's, we love helping our veterans because of course veterans have the best type of loan. That's going to tell me if they can go on a VA loan. If they say they're not a veteran, then I'm asking them, next question I ask is, what is your credit score, right? Because now if I've eliminated if they can't go on a VA loan, the next question I ask is, what's their credit score? Because of course a lot of times with higher credit scores, conventional is better. With lower credit scores, FHA is better. So then they answer that question, and then that takes me to the next step. If they have a little bit lower scores, then I know I'm probably going FHA. And now that I know I'm going FHA, I know what the minimum down payment is at that point in time and telling them. If I know they're going conventional, I know exactly where it is. And then the third question I ask after that is, okay, where are you buying? Because then based on where they're buying, sometimes there's a USDA loan. If they're buying out in the country, there's another 100% financing where they may not need a down payment. So those kind of give me their loan options just by knowing those factors. And then I know how much money they got to come up with initially. But then it gets a little bit further from there. Now that I know how much they have to put down as a percentage, the next step is I have to ask them how much income they make and what price range they're looking at. Because you can't tell them how much they need because 3.5% on an FHA is only $3,500 on a $100,000 house, but on a $300,000 house it's $9,500 plus closing costs. Yeah. And then of course, once I know that, and I know those details, then of course, then we also check in to see if they qualify for grants. Now, since now I asked them their income and we know what price range they're looking at, then at that point in time, I know if they qualify for certain programs and how much money of that I can get paid by a third party. And then it gets one step further. Then once we get them fully qualified, we know what their probably worst case scenario is to buy a house. Then, of course, we work with the realtors just like you to say, hey, this is their budget. This is how much they have saved. We have them on this program. But then they need this much in closing costs in order to have enough funds to close. And, so the question can vary and every person's different. But I've gotten people into closing where they're getting money back at closing, their earnest money and everything else. And I've had deals where they're having to put $50,000, $100,000 down to qualify for what they want. But that's the bit extreme, and the other one's a bit extreme. But for the most part, people can get in as little as 3 to 3.5% down. That's a standard. Like conventional with first-time buyers, the minimum down payment is 3%. On FHA, it's 3.5%, and VA and USDA, you can get in with 100% financing. And then, of course, if they do qualify for a grant, if they have to go FHA or conventional, the grant may cover that, so that they're not even having to come up with a down payment. They're only having to come up with their closing costs, which then at that point can be rolled into the loan or negotiated with the seller. And that's something that they'll work closely with their realtor on that part. So that gets crazy. But the myth is they need 20% down, and they don't.
Yeah. And I'm pretty sure there are benefits. So let's back it up a little bit. First, starting with credit. Okay. What does their credit need to be?
Well, now most lenders you'll see will usually go down to about 620, sometimes 600. We've been as low as 580. Now, due to COVID, they have an extra guideline on us where we just can't go down to 580 right now. But right now with our bank, currently the minimum credit score is 600. Starting point. They got a 600 credit score, which is not considered good credit at all. So you don't need to have perfect credit to buy a house, but that's the starting point for us to be able to start, getting someone pre-qualified.
Now, are there benefits to having, what would you say to the person where, okay, maybe their score is 600? Okay. Should they wait until they can bring their score up to a 700? I mean, it's based off of what you're seeing. What kind of change does that make in the loan and the terms and the interest rates? Is it worth
I never advise someone waiting if they can get pre-qualified. Now, when they come in, say we pull their credit score and they have a 600 credit score, right? It's not perfect. And if I can get them pre-qualified right then and there, I always do that. Now, that doesn't mean that we don't talk about how to boost their scores. Hey, pay off this debt or do whatever so your scores come up. So maybe by the time you find a house, you'll be able to get a better deal. Or maybe while you're looking for a house, because sometimes with a higher credit score, you can qualify for more house. But sometimes I have a customer comes in with a 600 credit score, and I have to keep them at a certain debt to income ratio. And like maybe, for instance, I'm qualifying for 200, and they're like, man, I really was looking at houses about 225. And I'm like, I'm sorry, but you're at a 600. So we have a choice now. You can go out and look at homes for 200,000 while you work on your credit, because what if a great deal comes up, right? Mm-hmm. Or you can just wait till your score comes up, and then we'll approve you for more. So it's just really on the action. And I've had that happen so many times where I'll have someone come in with a lower score and I'll give them approval for the 200 and they're like, man, but I really want 225. I said, well, get with your realtor, go out there, see what's out there at 200,000. And many times they find a house right then and there. Now, the score difference, that's sometimes
How does the score impact
higher allows you to qualify for more. Now, yeah, because I'll give you an example. Like FHA has a guideline where that if your scores are under 620, you can't go above a 45% debt to income ratio. But if you are above a 620, you can go up to a 50% or higher, sometimes debt to income ratio. So that allows me sometimes to buy more house because they allow me to go higher. So the score does affect that. Even on conventional, with higher scores, like sometimes Fannie Mae, like on a conventional loan, will allow you to go to a 50% debt ratio. But if you have a lower score in some areas on conventional, it'll only allow you to go to 45. So a 45% debt to income ratio. And a debt to income ratio is the percentage of all debts compared to your income. And, it's not that complicated of a formula, but that's how it works. So the higher your score, the higher you can get approved. Also, the higher your score, the lower your interest rate might be, right? And of course, if your interest rate is lower, then that means you can qualify for more house because the payment's cheaper. Because how we qualify someone is not based on sales price. That's a big myth. Have you ever heard this before? That's not based on sales price.
Right.
It's based on the total monthly payment. So, so that's what we look at. So like I've had it before where I would approve someone for say 200,000 and they're like, well, Cliff, there's this house I like, it's 250. I'm like, you don't qualify for it. And I said, well, get me the address. And then all of a sudden it's out in the country somewhere and the taxes on the property are only 800 a year instead of normally on a $200,000 house, they're 5,000 a year. Well, now he qualified for 260,000 out in that area. And it's not because of the sales prices, because the taxes were lower, the insurance was lower. It brought it below the maximum payment that person would qualify for, and they're okay. So sometimes the exact approval amount can vary from area to area,
So another thing that comes up sometimes when I'm talking to buyers is being able to be approved for that type of home that you want. And so, for example, we might have, families that are working off of one income. Perhaps, they're only going to use one person's job or whatever that situation is. But based off of that one person's income, they don't qualify for the type of house. How do you determine what you're approved for?
Okay, how would I determine what I'm approved for? Now, the way that they do that is, of course, it is based solely on income and your credit score, right? That's going to give me a max one. That's going to give me your max debt to income ratio. And if they can't qualify for that amount, there's only a couple things you can do. A, ask your boss for a raise. If that will help you get more income. Secondly, we can reduce debts. Sometimes I'll have people pay off credit cards or loans. Third thing you can do is maybe possibly get a cosigner. A lot of our loans do allow cosigners on our loans. So that's, that right there will help as well. And so once you do those three things right there, once you've exhausted those three avenues, there's not a lot you can do. And another example is where sometimes I'll have someone come in and the person makes money per month. Like there's the husband and the wife or the spouse, right, on the loan. Well, maybe the spouse's credit score is not high enough. So now you can't use their income because if they're not on the loan, they can't. So then you run into that issue where, hey, we know they can afford more house, but we can't prove it because they're not on the loan. And so you run into some issues. So, gets a little bit more complicated on those ones, but where there's a will, there's a way. But in that case, what if we have that situation? You have one borrower and their spouse their credit scores aren't high enough, but yet I can get them approved for a certain dollar amount. I still issue the approval to tell them, hopefully you can find something in that area. But while we're looking, we're working on their credit score to allow that person, we're working on the credit score to allow that person to be able to get approved for more in the event that they can't find something in that price range, So that's what I always say. We're working on plan A while we're working on plan B.
Absolutely. So let's jump into credit scores. And working on things. What are your thoughts on credit repair? And then what type of debts should they be focused on paying off? So right now, the student loans, they're not in repayment. So the question was, how is that taken into account when the government's not requiring you to pay back your student loans? The last I heard was till the end of the year. Is that still a factor? And how do medical bills fall in line? What are the
Okay.
things that they should be focusing on when it comes to their credit?
All right. Number one thing on credit, I tell people, credit, repairing credit's not hard. You do two simple things. You add good, get rid bad. That's the simple formula to improving credit.
Hold on,
A lot of
repeat that.
times, the
You were
number one
breaking up a
to
little
improve someone's credit
bit.
score.
You said
Oh,
repeat that because you said you do two things, but then you broke up. Well,
two simple things. We add good and we get rid of bad. Right? Now, you have to do both in order to see your scores come up. When you do just one or the other, right, it's not going to make a difference. And I'll give you an example. Say my credit scores are low, right? And I hire a credit repair company to start getting rid of inaccuracies, old data, collections and bills that may not be mine or whatever, just old stuff. But what if I have 20 bad items, right? And I hire this credit repair company and they go out there and they get 15 bad items deleted, right? Well, you still got 5 bad items on there. You still have bad credit because you never added any good. And that is the number one complaint that most credit repair companies get. They're like, I hired this credit repair company and my score didn't change. And then I'll look at their report back then and they had 20 items and now they had 5. I'm like, the credit repair company did a great job. They got rid of the negative.
Yeah.
But you never went out there and added the positive because no one can do that for you. The positive is I don't go late on anything anymore. Yeah. Lates are a big issue because that'll drop your score quickly. I don't go late on anything. I don't have anything going collections while I'm trying to build up my credit because if you go have another new account going to collections, it just drops your score again. Mm-hmm. Third is, which is one of the, I should have put this one as number one, but I wanted to go through the collections. But the number one thing that I see on most people whose scores are not high enough to qualify, they don't have revolving trade lines. A credit card, a revolving trade line is actually 35 to 40% of an overall credit score of a borrower. So it's kind of like, there's one question on an exam that you don't know the answer to, and you're going to lose 35 points. I'm like failing day one, so you got to establish credit cards. And so one of the big things we see is when people don't have a lot of credit, we go open up a secure credit card, get added on as an authorized user to your spouse's credit card, start building credit. And you'll see a miraculous change really, really fast. And now, as far as like collections and things like that, as a bank, you'll hear that we don't care about collections. We don't care about medical collections in most cases or regular collections. However, they still affect your score and your debt to income ratio on some stuff, but we really don't care about them. But if you got a lot of collections, your debt to income ratio is higher. If you have a lot of medical collections, we don't care about them at all. Right? But it does keep your score down. So it's kind of a contradiction that, we don't care about medical collections. I didn't think they mattered. Yeah, they don't matter. You can have $100,000 in medical collections. I really don't care. But if your score is not where we need it to be, it still poses a problem. So sometimes having to get rid of those medical collections just to get the score up is important,
So what I'm hearing then is that if I'm building my credit, I need to establish new
credit as soon as possible.
Credit. So a secured card or credit card.
A secured credit card or a normal credit card, never any installment loans, going and get a new car. Those things don't help. In the long run they do because you have to have those for a while, but revolving credit card instantaneously can boost your credit score up.
Awesome. And then the positive.
Yeah, and that's if they have bad credit. But now I've had many people come in that do not need credit repair, right? Mm-hmm. They come in, their scores are a little bit on the low side, and they're like, I pay everything on time, but my credit's not the greatest. And the first thing I look at is what's the balances of their credit cards. And I'll get people all the time that come in that they pay their stuff on time, but all their credit cards are maxed out. Okay. And when you start maxing out credit cards, the higher the balance, the lower your credit score goes. So you want to get that balance down as soon as possible.
So is maxed out like just I don't have any more room on a credit card?
Exactly. I see that a lot. Or they're over the limit.
So where should I be if I have a credit card for $500?
Now, a good rule of thumb is, now you'll see this is standard on all credit repair websites, is to keep at 30% or less, right? Now my motto is, and it says or less. Now my motto is at 10% because when you see the credit scale, like say it's maxed out, right? Let's say your credit card's maxed out and your score's here. As you start paying it down, your scores come up. When you hit that 10% level is at your highest. Okay. So 10% of your credit card. So if you have a $500 balance on a credit card, you want to keep that, or a limit, and that's a limit. you want to have no more than a $50 balance on there, right? Now, you don't want a zero balance because it's kind of weird. When you pay it down to zero, your score drops a little bit. Because
I
if you
hear that
don't,
a lot. I hear a lot of people say, well, I paid off my credit cards and my score went down. What gives?
Yeah, well, you don't play the game, you can't win points. That's how I tell you.
Trying to keep us in
Yeah.
debt. I get it. So, you know,
Well,
and I know go ahead.
I didn't miss that. I missed that. What'd you say, Chase?
I said, I know
missed what you said.
it's
You
all
broke
a
up.
racket to keep us in debt and out of debt at the same time. I don't
Well,
understand.
I wouldn't say it is. You want to know why?
Why?
Keeping you in debt a little bit actually saves you money. You got to think about it logically. Now, what I mean by that is, you know, they're not saying, because what it costs the credit bureaus money or the credit card companies money to report every month. That's how credit bureaus make their money. So if you're not spending a little bit of money, it's not like you got to max it out. But if I fill up my gas tank once a month and then pay it down to $10, I pay pennies in interest. Pennies, or even say it's $1. Let me ask you this. If I kept $10 on my credit card at all times, so I always have a balance, and throughout the year I spent $10 in interest, but yet my scores are very high. So when I go buy my car note, I get a better interest rate. When I turn on my light bill, I get a better interest rate. When I go get shot for car insurance, I get a better interest rate. When I buy my house, I get a better interest rate. Everything's lower. Is it worth paying that $10 per year? Because it's not costing you money, it's saving you money. So when you look at it from that perspective, you don't want to keep credit card balances at a zero, but we're not telling you to go shop. You know, like me, I use my credit cards. Like I'll have one credit card where all my bills go on there every month, and then I pay it down. It's just like paying it cash, and so I'm using it all the time, and it helps out. Now, even if it has a zero balance, your scores are still going to be higher, but a small balance on there will give you your peak. And another great tip is, and people are afraid to do this. It's kind of funny. Request limit increases on your credit cards, and the reason is because the higher the limit you have on your credit card, right, the higher your score is. But also the number one reason is say you had that $500 credit card, right? And if you spend $50, you're now at 10%. So if you go spend $150, you go out to dinner with your spouse and out to the movie, you spend $150 on your credit card, your score drops. That's unfair, right? Wouldn't it be nice if you had a $5,000 limit? You'd have to spend over $1,500 on that limit. You have to spend over $1,500 on there before your score drops. You'd have to spend over $500 before it affects. So you want as high a limit as possible. And I always get this from customers. Yeah, my bank offered me a $10,000 limit and I turned it down because I didn't want that. I'm like, we're not telling you to go out there and max out the $10,000 now, all right? You know, don't go to Vegas and spend it all, but you want as high a limit as possible. So once a year, request limit increases, because if they're willing to give you a $20,000 or $30,000 limit, great. That means, hey, I can go spend $2,000, $3,000 on a weekend and my score is not going to be hurt. And you want that, you know, because people have all these small credit cards. They go out to dinner and their score drops. It's ridiculous. So you want a high limit, you know?
Awesome. So moving next, down payment programs. We get a lot of questions about this. There's a lot of rumors about it. How do you get it? How do you qualify? Is it the best bet? So let's just have a, you know, unfiltered conversation about what are the down payment programs that are out there and what do you need to know about them?
All right. Well, down payment assistance programs, we've been doing them for over 10 years, almost 15 years, these programs. They're great programs. There's good, bad, and ugly about all programs. There's, you know, we love all of them and, you know, we do them all, right? You know, but the pros and cons, like sometimes, you know, like if you're using like some of the big grant programs like City Houston or Harris County or Galveston County, they offer the larger grants, but those ones take longer times to close. So sometimes you run into an issue where the sellers don't want to give you enough time to close, so they can't use that program.
Why do they take longer times to close?
Well, because they got to get approved by the city. It require extra inspections. Like Harris County has to go to court every month, so you have to have your full file approved. Then it's got to go to court for them to approve it. And then after that, they issue the approval for funds. So you just can't close when you want. Wow. You know, so some of the bigger grant programs, there's a lot more paperwork because they're giving you so much money from the government. And when you get a lot of money from the government, don't they want a lot of paperwork?
Yes, they do.
Yeah, so those ones are a little bit more difficult. Now, there's other grant programs that through the government, like through the housing finance agencies, like the Texas Department of Housing and Community Affairs. There's Southeast Texas Housing, which is Seth, and there's TSHAC, which is for teachers, firefighters, police officers. Those three programs are pretty much self-funded programs because they give you anywhere from 2 to 5% in assistance. But what it is, you'll notice that the more assistance that they give you, the higher the interest rate they give you, and that is set by them. not by us as a lender. So it doesn't matter what lender they go to, they're going to get the exact same rate. And the way it works is because over the life of the loan, they're making more money back on it, which then allows them to fund more grants, right? So they're less paperwork on those ones. They're a little easier to do. But of course, we always say you want to get the minimum that you need because you want the lowest rate possible. So sometimes I'll have people that may qualify for a grant and they won't use it because they don't want the higher rate, they want the lowest. And so that happens on occasion. And of course they do have higher credit score requirements. Like currently right now you need a 660 credit score to get those. So if you got like a 600 score, you can't use that program. You have to come up with your own down payment, because those are the reason why they're based on that is because it's based on the credit score allows them to give you more money in assistance. So they require a higher score and a lower debt to income ratio to qualify for them. But they're great programs and we use them all the time. But there's also tax credit programs as well. And like in this area, like in Harris County and Missouri County, people can make 90,000, or in Missouri County, I think it's like 110,000 a year you can make and still qualify for a government tax credit, where the government will refund, 20 to 40% of the interest you pay on your home for the life of the mortgage, up to $2,000 a year on your tax refund. So if you kept the house for 10 years, that's $20,000.
Now, is this only for first-time buyers? I mean, are there programs for people that have bought before, or what about that?
Yeah. Now, the tax credit programs are only for first-time buyers, but also keep in mind the classification for a first-time home buyer is I have not owned real estate in the last 3 years. So like say I sold a house, 5 years ago and I haven't owned in the last 5 years, you are a first-time home buyer. So remember that rule. And also it's a sad situation, but we've seen it before where you're also reclassified as a first-time home buyer if there's a divorce and say one spouse got the children and the other person got the house. The person who didn't get to keep the house can sometimes be reclassified as a first-time home buyer. Awesome. Because they lost a house. So, so there's that rule. But several of the grant programs like SETH, TDHCA, and TSHAC, if you're just using the down payment assistance program and you qualify credit score wise and you're in the income limits, you don't have to be a first-time home buyer. You could have sold your home last week and you can use that program right now. Like maybe, what if you have a customer who sold their home and they didn't have a lot of equity, so they didn't really make any money when they sold it, but they want to buy another house. Mm-hmm. Well, they can use that down payment assistance to buy another house, so long as they meet the income limits and the credit score requirements.
Awesome. So of course you are the expert on this. Clearly you guys can hear that he's the expert on this. So we encourage deeper conversations with you like that. The final thing I wanted to move into, and we're seeing it, and I actually have the market update of just kind of what's happening. Okay, so Cliff, I'm always on the phone with you. The market's competitive. My buyers are getting in competitions with multiple offers. How can we win the deal? What do we need to know from a smart buyer's perspective on how to win the deal? I mean, what are your thoughts on it? Because we've got...
Well, it can go several different ways. We see it all across the board. First and foremost, we tell clients, even though I get you approved, you got enough money for down payment, closing costs, always continue to save money, because you never know what the final outcome is. The house might be a little bit more expensive, or the seller doesn't want to pay closing costs, and you need to be ready by continuing to save money to plan for worst case scenario, because cash is king, right? Now, what if you don't have enough money to buy it and you're in a multiple offer situation? Sometimes buyers have to offer more than asking prices. I get a lot of contracts in where, or even conversations with buyers are like, well, hey, I'm going to ask the seller to come down $10,000, $20,000. And I'm like, you don't have enough money to close. Is it better to ask for a reduction in price or closing costs? My point of view is always ask for closing costs, because the reason is I'll have customers who will come in and they're asking for $10,000 off the price. They're buying, say, a $300,000 or $250,000 house, and they're asking for $10,000 off the price because they just want to feel like they've got some kind of savings. Well, getting $10,000 off the price saves them $50 per month. But now they're having to bring, and they didn't ask for any closing cost. Right. Well, now they're having to bring that $10,000 to closing. My challenge is get the $10,000, pay full price and get the seller to pay $10,000 in closing costs instead, or a little bit above, because now, yeah, your payment's $50 higher, but you don't have to bring $10,000 to closing. And I guarantee you this, if you've got credit card balances, car notes, and things like that, if you were to take that same $10,000 and pay off debt, you'd save way more than $50 per month. and you might qualify for more.
Yeah.
So a closing cost is way more important than a price reduction. So remember that. So if you're trying to get a good deal, those two things are the most important. Ask for closing costs is more important, especially if you're trying to bring your cash to close down, or if you have to pay off debt, or maybe you want to buy new washers and dryers or new furniture when you move into the house. Having cash in your bank after closing is more important than saving $50 per month. Because wouldn't you mean you agree? I don't $50 make or break anyone per month, but sometimes coming up with $10,000 can.
Absolutely. Yeah, it makes sense. And especially, like, I think you mentioned rolling in the closing costs. So I always
Oh
tell
yeah.
people, remember, when you ask for closing, you are asking the seller to take money out of their pocket and
Yeah.
give it to you to buy their home. And so
Yeah.
sometimes it's hard to get a yes, especially in multiple offers, when they have to pay you basically to buy their house. So consider rolling the amount that you need into the offer,
Yeah.
basically increasing the sales price, or going above asking. Because what I'm hearing, Cliff, is that it's not going to change
The
their
payment by that
monthly
much. I've had people who are short $5,000 to close, and I'm like, they're asking 250. Speak to your realtor. Do you think it'll appraise for 255? Roll that $5,000 in, so you're not bringing that money to closing, and then all of a sudden your payment's what, $20, $25 higher,
Yeah.
and that's problem solved. You're good to go. So that just the way that you do the mortgage math and the way you structure the deal is just as important as the pre-qualification.
Yeah.
So make sure you structure right. And my structure is always rolling closing costs, or if you can get some paid now. Sometimes it's both. Like, say this example, you needed 10,000. What if the seller wanted to pay 3,000, and then you roll 7,000 on top, so long as the house will appraise?
Yeah.
That's a better way than just getting the 3,000 and then you have to bring an extra $7,000 to closing. Because guess what? Even if there's an appraisal issue down the road, we can adjust it. But I want to plan for best case scenario. And then, hey, we got plan B in the event that there's an issue with appraisal or something else like that.
Absolutely. So, well, Cliff, I know low interest rates are low right now, meaning people keep hearing that they're low right now. I want to buy next year. That's
Okay.
when I'll be ready. Should I be fearful that interest rates are not going to be the same, or am I okay waiting and getting myself together? I mean, what do you say to that person that they're not buying it today. 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 Right?
Okay.
We get it.
We get it.
Rates are low,
I
but
just
we're
signed
not
a new
buying it
lease.
today.
I want to save more money. You hear that a lot. And well, one of my big factors I hear is I want to save more money so I can put an extra $10,000 down. Right. So that way I save the $50. Well, if interest rates jump up % and your payment goes up by $100, so why wait? I think that's always a silly reason. I want to wait to save more money. Now, also that 1 year that they took where the market's a sales market, the value's gone up $20,000. So not only did it go up in price, interest rates went up. So waiting is never a solution unless you're in a lease or something. There's a reason you can't buy, or there's a credit issue, maybe not. But rates are historically low. They plan to be here for a while, and I think they're here probably close to the end of the year, but always near elections, that they're lower. Pandemic has them lower. Once elections are done and once they find a cure for the pandemic, we're going to see those interest rates start to rise.
Okay.
And rates are really low, but even if they rise a little bit, rates are low. I remember when I got started in this business, rates were 8. And I remember people were getting 7s. They're like, oh my God, the rates are so low. Then all of a sudden you hear 5s. Oh my God, the rates are so low. Then you hear 4s. Rates are so low. 3% rates. Well, guess what? When they rise up again and you get a 4 in the future or something like that, who knows what it'll be? It's still low, and it still makes you more affordable. Great. But the reason why it's so busy right now in a lot of people is because with rates being where they're at, it gives people more buying power. It's not about the payment going up, because that same thing, because if rates went up, their payment goes up. But with rates being lower, not only if I'm comfortable at a certain payment level, that means instead of being able to buy 200,000, maybe I can buy 220 or 230, and my payment's the same as it would have been. I had a customer last year that we had them approved in December, and they were looking at a good example. She was looking at around a $200,000 house, and rates were higher then. Right. And then now she qualified for 250,000 because the rates are so low. And her payment is the exact same now as it would have been last year because rates had fallen so far. So it does make a difference that you can usually buy a better house with rates being low and keep the payment a lot more affordable. So waiting isn't the solution. I always say find a way to get it now, because values are going up, rates are going up. Get it now is the best time to get a house.
Awesome. Well, final words. I just wanted to touch. We didn't go into full detail yet. I always tell people before I got into real estate, I was a bartender, and so talk to me about people that make non-traditional money. So either
Okay.
they are self-employed or they are in a tip-based business.
Okay.
Can they get a home?
Yeah. If they did their paperwork right.
Uh-huh.
Nah.
Yeah. Taste the
That's the thing.
food.
Because for instance, I've done many a clients that been bartenders or waitresses and things like that, and we've gotten them houses, but they claimed their tips. I can only use what you claim, what's on your pay stub or federal tax. You can like, I've had a waitress one time. She's like, "Hey Cliff, I make about an extra $500 a month in tips per month. That should qualify me for another $40,000-$50,000 in house." I'm like, "Great, show me a check stub that shows it." "Oh, well, it's all cash." I can't prove that. I understand that you may make it, but I always say, Uncle Sam's from Missouri, the show me state. I gotta prove this stuff. I can't just say, "Hey, take your word for it," because no one takes your word for it. Not because buyers are bad or anything, but there's been a lot of fraud, a lot of criminal activity. We just won't use verification stuff that we can't verify. So the only way you can use it, and I've had people where they're like, "Hey, Cliff, I have a cash business and I've been working for 2 years. How do I prove my income?" File your tax returns, because you can go on your tax returns. If you didn't claim your tips, right? For instance, on your pay stub, when you go file your tax return, you can claim your tips then, saying that you earn this much cash on a
Okay.
year for your business. So if it's not on your paycheck, if it's not on a federal US tax return, that income is useless to us.
So no duffel bag,
Mm-mm.
no duffel
No
bag.
cash money. No cash money.
And then,
You'd be like, "I'm a waitress." The banks automatically think you're a drug dealer. That's just the way
yeah.
it is. Why do you got cash? That's why.
And then I'm hearing your taxes. So if you're self-employed, then I can't use that many deductions, or I mean, that's
Well,
the point of.
let's be honest on here. It's not that you can't do deductions. Everybody has deductions. When you have a business, you have business expenses. But if you made, say, 100,000 in your business, did you really have $100,000 in expenses? How did you pay your bills?
Yeah.
We know that's not accurate, but I know that if I usually see that they made 100,000, they had 100,000 in deductions, they probably made another 100,000 in cash because they only claimed their checks and other stuff, and they're not putting their cash on there. That's the problem. You're not claiming your full income, because if you truly had $100,000 in deductions and you lost money that year, how'd you stay in business? It's just not possible. And you see it 2-3 years in a row that you've lost 10, 20,000. It's time to shut that business down if that's true. You have to claim the amount of money that you really earned.
Yeah.
Write off the real expenses. And it's fine if you made 150,000 and you took 100,000 in deductions, then you made 50,000. Yeah, you have to pay Uncle Sam. You're going to have to pay a little tax, but at least you'll be able to buy a house. But you won't be able to if you don't show your true real income.
Well, like they say, to whom much is given, much is required. We pay taxes because that means in some area of our life, we've been blessed in our business. And so
Yep.
it's a catch-22, right? Those
Yep.
that don't owe taxes generally haven't earned the money to pay them, right? So you kind of have to
Exactly.
be careful what you wish for.
And
Cliff,
I always say one of my favorite questions is, would you rather be the person who paid $50,000 in taxes or $500,000 in taxes? Which one would you rather be?
I just want to not have to pay them at all, but 500,000 in taxes with a bunch of
Yeah, because the question is, if you had to pay Uncle Sam $500,000 in taxes, how much money did you really make?
Right.
Yeah, you did very well. It's okay. That's what pays for government. All these programs and things. Hey, I'm always the big proponent. Pay my fair share. What I got to do. And so it's okay to pay taxes. I understand we want to reduce that as much as we can, but just don't go crazy on it. You want to buy a house, you're gonna have to pay something.
Absolutely. Well, Cliff, we appreciate you jumping on this call. It's important for our team to know that we partner with local business owners, that we work with people that you can still see, feel, touch, that you can communicate with them and have a transparent, honest conversation just like we did today. So, Cliff, for those people that are ready to start the conversation, how can they get in contact with you?
Well, my direct number anytime is 281-978-2106. right? So that's a 281-978-2106. Another easy way is my name, Clifton Saunders. You can go to cliftonsaunders.com or Google Clifton Saunders. You'll see, you read about me and my team. We've been doing business in the area 15 years, tons of great reviews. So Google Clifton Saunders and my website's going to come up first page of Google every single time. So, but that's the easiest way to reach me. I go by call me, text me, whichever one's easiest for you.
Absolutely. All right. Well, thank you so much for tuning in. You guys have a wonderful day, and we are glad to work with you. Bye.
Awesome.